Q&A. All right, we are live, everybody. We have several people already in. Go ahead and find the chat box. Let us know who you are, where you're from. This is a live Q&A where we're going to discuss where to deploy capital in uncertain times. If there were ever uncertain times, it is right now. So we have a group of investors that I work with, both here in Little Rock, where I'm based, and our marketing firm. And we're going to show you where you can take some advantages of what's happening in today's market. So everybody make sure and find the chat. Let us know where you are. Andrew, welcome.
Syracuse.
Nice. Good to have you. You have a bunch of friends out there, so make sure and say hi. And so what we're going to be talking about today is what's happened in the market as a result of the coronavirus and what your potential investment options are, where we see the market opportunities, mostly in real estate, but we'll talk about some other disciplines as well. People are starting to chime in there from all over: Honolulu, Oregon, PA, Lancaster, PA. Welcome. And go ahead and let us know where you're from and what is your current question? What are you doing in the marketplace right now? What kind of business are you in? Are you impacted as a result of the coronavirus and all the social distancing protocols that we're all having to do right now to flatten the curve of the spread? And what kind of concerns or questions do you have? Go ahead and plop those into the chat group or to the chat. And these other guys here will be fielding these, will be answering questions. I'm going to go through a conversation and go ahead and drop your questions in there. And if it's something to clarify what we're already talking about, we'll make sure and jump on that then. Or if it's more specific about your situation, we'll have a live Q&A at the end of this presentation, which I think will go about 45 minutes, and then we'll open up to live Q&A about your particular situation. And so Pablo's asking, should I be buying right now? He's new. And so that's what we'll be talking about right now is what are the possibilities? Okay, so the all too common disclaimer, but it's for a good reason. None of us on here are professional advisors, and we want to make that very clear. We are investors, and we're going to be sharing with you what we see and what we're doing, and you need to be making decisions for yourself and seeking the appropriate counsel for your specific situation. So everything shared on here is not tax, legal, or professional advice. And you already know that, but you know I have to say it. So let's just jump into who we are. If you don't already know us. First off, I'm Paul Thompson. I often go by Paul David Thompson because I have the pleasure of having a very common name, and paulthompson.com was taken long before I thought about getting it. I'm a full-time real estate investor. I started buying single family houses, and I bought enough to basically replace my income. And so I no longer go to a day job. I, so to speak, tap dance to work every day I've been quarantining in my house for the last 2 or 3 years anyway. I didn't know I was preparing for the coronavirus, and I've done a lot of deals in that time. And I kind of lost track. It's after 100, I stopped counting, and I don't really know how many total volume it is, but it's something over $2 million. And I was a guest on the Bigger Pockets podcast where I talked about my journey from escaping my day job and the mechanics of how I did it. And it was one of the top downloaded episodes according to Bigger Pockets. And I think primarily because I get into the details of how I did it. I also have my own podcast called Ready Investor One, and I wrote a book called Escape Your Money Mindset to Freedom. And I also run a mastermind and coach people from all over the world on how to do real estate investing in the US. And so I'll tee it up for Josh to do a quick introduction.
Yeah, thanks, Paul. I'm Josh Eberly. I'm based out of Lancaster, PA. I'm a digital marketing business owner. Spent about $1 million plus on digital marketing dollars the last couple of years here. Anything from Facebook to AdWords and everything in between. I scaled and sold ownership of my first company when I was 23. I'm honored to be partnered with Austin, who's also on this call. And probably my biggest accomplishment to date is that I'm married and have a kid on the way. So I'm pretty excited about that. As Paul said earlier, I think, we're all in this for the personal freedom, and we'll talk a little bit about that later, and how to create revenue, while you're sitting at your house, essentially. So with that, I'll tee it up to our next panelist, Cody.
Nice. Thank you, Josh, and congrats on the new kid coming this your way. But my name is Cody Dover, and I am from Little Rock, Arkansas, and I do work with Paul and Chris here, as well as Austin and Josh there on the marketing side. But, I started at 22. I got into a program, of course, followed what they taught us, and then just got, jumped right in. And to this day, I only own 8 units. I've had my hand in a few other deals, probably 15 or so, whether it's flipped, wholesale, whatever it may be. And I do like to spend a lot of time networking and building relationships and just bringing opportunities to people. And then it looks like we got Chris next.
Hey, what's going on, guys? Chris here, Chris Kolstead. I would say, about myself, I do business with Cody, Paul, Josh, and Austin. The biggest thing for me is real estate has been that freedom thing, the freedom seeking thing where I'm able to do what I want to do. And so I left my corporate job here recently to pursue real estate full time. Cody and I bought our first rental properties when we were 22. And I'm excited to be here to share this with you guys. I currently work in the sales department of the company, and I do a lot of training for elite mental performance. And I'm just really excited to be here and be around these guys and share this with you.
Yeah, hey, I'm Austin, and I am married, and I am also, I have a baby on the way as well, like Josh. So we're both in the same boat. We're partners, like you said. And I didn't realize this, but I did beat Chris and Cody by 1 year. I bought my first rental property at 21. So, I did get that done. But Josh and I, we own 12 units between the two of us here in Lancaster, Pennsylvania. And now we're focusing on wholesaling and doing marketing for other real estate professionals. So really excited to be doing this.
Excellent. So let's talk about what the market challenges are here. I've seen some questions out there in the chat. Should you wait for things to calm down? Will banks be lending? Should I buy now? And so the only certainty that I know right now is that these are uncertain times. And so I'm never a proponent of timing the market. I believe fundamentally in buying based on the fundamental aspects of an investment. And we're going to talk a little bit more about how we adjust and changed our underwriting criteria and kind of the way we're marketing a little bit differently as a result of what's happened with COVID-19. But I'm also going to be sharing what the larger macroeconomic drivers are and why we made some of those changes. And then and what I really want to get down to is, from a personal level, what do you guys do right now? Where can you find yield? We know the stock market is volatile. We're unsure about how long people will be unemployed and what the government has done to kind of prop up things. So let's just dig right into that. So if any of you are investing in the stock market as well as the real estate market, if you have a 401k, about the last week of March, it dropped to a 201k, just like it did in 2008, which is something that I went through as well, where I realized that was probably the biggest opportunity of my lifetime, at least up to that date. And I wasn't prepared for it. I didn't know what to do. I was still in corporate America, and I felt like there was a great opportunity, but I hadn't really planned for it. And ever since then, I have been spending a lot of my time becoming a active investor, to prepare myself for when the next thing happens. And of course, I didn't know it was going to be in 2020. I didn't know it was going to be a pandemic. I didn't know what the recession was going to be, but we all knew it was coming sooner or later. So I've been touting for a while that if you can become a good investor in a good market, then you can become a great investor in a bad market, because things are easier. And what will the market do next? Anybody that tells you they know is guessing at best, and they're probably wrong. And none of us are Nostradamus, and we don't know. I do not believe in timing the market, because you're almost certain to be wrong. What I would instead think about is, what are the prevailing trends that from previous behavior that would seem to line up with what's happening now. So this is a really interesting graph that compares the Fed rate, the Fed funds rate, to the mortgage rates and how they are loosely tied together. So the Fed funds rate, if you don't already know, is the rate that banks use to loan to each other. And it's one of the first things that the Fed uses to influence the inflation of our economy. And so right at 2008, you saw that, or even before that, 2000, during the dot-com bust, they lowered the Fed rate significantly. And then we kind of worked our way up. You see that straight line, 2005 up to 2008, they were raising the interest rate back up again. Well, in 2008, one of the first things they did multiple times is to drop the Fed funds rate to basically create an easier open credit market. Well, we all know that didn't work very well and took them a long time to get some other things in place to kind of prop the economy back up. But what's interesting is what happened during that long rate of where Fed rates was near 0%. Look what happened to mortgage rates. We are in an environment where we're going to see the Fed funds rate stay low for a long time, at least the next 18 months. And subsequently, the mortgage rates will be about in that same box if you extend it forward. If the past really does indicate anything about the future, which we don't know it always does, but we know these two things are tied together, and we have a lot of history that says it is. So if the mortgage rates stay low, then the cost of money will continue to be low. And so the government also did the CARES Act, and I'm not going to go into this too much detail because I've covered this once before in the previous live Q&A that we did, and you can watch recording that if you want to. But basically, the government has done about everything they can to prop up our economy and keep the credit markets open, and they responded very quickly. I think March 10th was kind of when it really hit the world that the U.S. was going to be affected by this, really. And there was a new bill in place by March 27th. So it took them about 2 weeks to write an 880-page document for our law that allowed $2 trillion to allocate $2 trillion to go into the economy. Now, we know there's been some trouble with actually applying for some of these loans, but stimulus checks will be coming soon. And there will be money back in the hands of some people in the next 2 to 3 weeks. And so these stimulus checks for a family of 4, you're going to get about $3,400 if your kids are 16 or under. So as a lot of people are worried about whether or not you're going to be able to afford rent, they're potentially going to afford rent. There's potentially $3,400 to every family that is a family of 4 that will be in their pockets soon if they file their taxes with a direct deposit last year or the year previous.
So to pick up where Paul's at, when people are receiving this relief, the short-term relief is great, but it does have some long-term effects on the economy. And quantitative easing from an economic standpoint is like the Fed's last line of defense to influence the economy. And we have already taken those steps. So it's their next steps would be implementing more quantitative easing, essentially. And really, that is printing money. And when they loan money out and that money doesn't get paid back, well, you have more dollars in circulation now. And so the value of the dollar is actually going down because there's not a trade-off. So I do believe there will be long-term implications from this quantitative easing in our economy. And I do believe we will see some inflation that will take place. It is concerning, but it's certainly something that we'll continue to monitor, obviously, because it has a direct impact on our ability to buy goods and exchange, our dollar for, a loaf of bread.
Yeah, and the question there is, what happens when there is inflation? We expect there's going to be inflation soon. The government has done what they can, and they basically just kick the can down the road, and they're just printing money. And it's a near-term solution, but we don't know really what the long-term implications are. So as an investor, what do you do now? These are the underlying questions we're going to try and answer today, or at least give you some thoughts to percolate on. One thing that we've seen, which is really, I think, unprecedented in the U.S., is there have been 15 million, or they're projecting 15 million people are going to be unemployed soon. There were 6 million last week and 10 million since this thing started. So they project another 5 million people are going to file for unemployment. Some of that is an incentive that the government has given us in order to go and get their investment. And So what are you going to do about this when your tenants can't pay? Well, one thing that I found out is, as part of the pandemic unemployment assistance that you see there in the middle, is that unemployment now for many Americans that will be eligible for it will get paid more by not working and getting unemployment than actually working. So that, whether that's a good idea or not, I'm not sure, but that is the idea. That is the reality that we're facing, and they are starting to get checks already. So in the real world, tenants in the next few weeks, potentially come May, for the May's rent in the years, in the months afterwards, are going to have more money in their pocket than they were used to having in a lot of cases. So if tenants are telling you, well, we can't pay, well, there's a stimulus check coming and I can help you get unemployment because I know there's a very generous program. Have you applied? So I think for landlords, there's a lot of at least short-term relief that would indicate to us that there will be enough liquidity in the marketplace for most tenants to be able to pay their rent, at least for the short term. So now the big question is, what are your options as an investor? So I've talked about this in my book, and this we'll be kind of covering in today's presentation, is what are your choices? And I characterize those into really major three categories. So you can say the stock market or equities, the real estate market, and business. And those are the three different things that you can invest in. And some people would argue that you can also invest in like gold or cryptocurrencies, which are not equities, but I still put into the category as the air quote stock market, by buying shares of something, because you as an investor have no influence over the outcome. Whereas with real estate, you have some influence. And as with business, you have a lot of influence because you're investing in your own business and you're doing the work to make it happen. That's kind of the spectrum of choices that you have. Do you invest something in the stock market? Do you go further into real estate? Or do you start in real estate? Or do you reinvest back into your own business or start your own business? So personally, what I'm doing is that I invest in all three of those categories, and I have a stock portfolio. I have a 401k that went to a 201k and thankfully is back to a 301k. And I'm watching to see what's happening there, but I'm not selling. I'm not doing anything crazy. I'm not looking to time the market. What I'm doing is I'm staying the course. And that's what I think a lot of investors should do. Don't be irrational and sell just because you saw that there's this big decline. By doing so, you're probably going to realize your paper losses. You should only do that if to factor in taking care of your immediate cash flow problems that you might be having trouble with. That would only be the only time it makes sense to realize those losses. Conversely, I am doubling down on my current business. So I think I have a business that I've been preparing for. I've been learning how to get better and better at. And so I'm doing that even more with the guys on the call you see now. So buying income producing property is also my other approach, because I want to have another source of income that's out there that is indexed against inflation. So it's a hedge against inflation by holding property that's creating income now. But I would say I would not get into flipping vacation rentals or anything that's of the speculative nature, no matter what the asset class is. It's not the time for that. So where I see the market opportunities is that there are indicators that Josh will talk about here in a second, that the market is affecting the residential buyer already. We're seeing some early indicators that people are wanting to sell their properties quickly. Now, the residential market, where a homeowner has a property, they're not putting new properties on the MLS, but we're seeing more people saying, I need to sell my house fast and I want to get a discount. So as investors who look in real estate, we see that might be ramping up. Now, we'll see that the commercial space will probably take about 6 months of lag time before we see how much it's going to affect the commercial space. I think the way we work is going to change significantly, and there will be, like, if you're a WeWork type business, may not be the best thing, or the kind of businesses that would normally be inside of a WeWork operation may not make the most sense. So the virtual workforce, it was already a trend, and the COVID-19 reality is only going to increase that over time, in my opinion. So of those choices, why do I think real estate is a good choice? I will not say it is the choice. It is a good choice, and here are the reasons why. Because these other asset classes make sense. I'm in all three asset classes, but I spend my time in real estate because I feel like I have the most influence over it, and I don't have to be a genius to figure it out. I don't have to have a PhD to figure out the economics of the value of a given business. I just got to be able to look at a house and see what it's worth and what it rents for. It's really a very easy business. And I maintain that the demand for housing is not going to decrease as a result of what happened with COVID-19. We're investing in something real that has value, that I have the raw land underneath that is not going anywhere no matter what happens. And the demand is only going to increase because the supply is still limited and was only going to be more limited as a result of COVID-19. So what we do as a business is very simple. We buy real estate, we try and buy it at a discount, we fix it up and we rent it. It's not that exotic. But what we do differently than some is that we use private funds to acquire properties so that we can buy properties quickly. We also wholesale, we do hotels sometimes, and we do flip. Right now we're not flipping, but we might get to flipping when the market makes sense. That doesn't make sense right now. And so collectively between all of us, we own about 50 doors, and we're only looking to add to that asset or to that number. And I think we will buy it faster than we have been in the past because it was such a competitive market before. So here's the thing we're doing differently. So, and this is what we're doing. You consider this for yourself. We are looking at properties a little bit more strict. Our underwriting is tighter. When we're running the Mayo formula, we're kind of throwing in there a COVID-19 discount. We want to be able to buy at a deeper discount. So, but we're absolutely in buy mode, but what we're doing is avoiding flips, and we're focusing on buying long-term rentals. And what's different about marketing is we're not going to branch out and do something different. We're going to actually simplify and do more of what we know works, which is what Josh is going to talk about here in a second. And we're not experimenting with all these kind of creative approaches because now it's easy. It's going to be easier to find discounted properties and easier to find discounted sellers who are having a problem. There's just huge economic calamity that just happened. There's going to be a lot of people that need help, and they're going to need help fast. So what we're looking to do is position ourselves to be able to buy quickly. So I'll turn it over to Josh to talk about the marketing.
Yeah, so thanks, Paul. And a question came up here earlier from Tim about marketing. So I'm going to kind of jump into that here as I talk a little bit. So what I'm showing everybody here in a graph, and this is just Google Trends. So trends from Google itself, the keyword term, sell house now. Like people looking to sell their house right now. And you see that massive spike. And that's right about when we saw COVID-19 really affecting people. There's a lot of layoffs that week. It was about the second week of March. And you see kind of how people are reacting already online to the big shift. And Tim had asked a question earlier, hey, I'm a wholesaler or I'm looking for deals. Like, how do I find deals in this marketplace? And, I've been kind of talking this game for the last 2 years. So many wholesalers or so many people looking for deals, they're so used to that referral, people-to-people business. Well, if you can't go meet somebody because you're quarantined, how are you going to bring in deals? And I think that's what puts an emphasis on the digital side now more than ever, because there's some tactics and strategies on the digital side that you can use to get in front of the right people at the right time without actually having to talk to them. And this kind of goes into my point right now of paid media in general. If you're out there looking to, kind of start in paid media or get started and you don't know what to do, now more than ever is the best time to do it. Facebook's CPMs, so it's just cost to operate on Facebook, are way down, about 30%. A lot of advertisers pulled back their spend when COVID started. So the costs are way down. You can speak directly to your audience problems and you can solve it for them online. Now there's technology out there where you can record videos, you can put stuff out there that people can be reached basically in the comfort of their living room. And then you can call them, you can connect with them, and you can get deals done. The localized trust and credibility is really huge. We've seen that as being like a major differentiating point. A lot of the iBuyers have started to move out of our local markets. They've stopped buying, like Zillow stopped buying. They had a program where they were just offering people cash for houses. And I don't think that's going to continue with the market cycles we're seeing. So you have the opportunity to really establish yourself in your market right now as the go-to people. You're on the leading forefront with technology. And the other thing is a lot of competitors are stopping, right? Everybody with bandit signs, nobody's calling the bandit signs anymore. Let's be honest. Nobody's driving around. Nobody's seeing that stuff. So people are really going to be either online or they're not. And if you're not online, that's a huge opportunity you're wasting at this time. So I'm going to turn it over to Cody, talk a little bit about the Little Rock market and what makes it so special.
Yeah, so thanks, Josh. The Little Rock market is a unique market. A lot of people from the outer cities, the coastal cities, they kind of turn the Midwest off. Little Rock is non-volatility. It does not bounce up and down like some of the other major markets do. If you look back at the 07-08 recession down there, it's a linear straight line all the way across. The Little Rock market is also a landlord state. This is where we can find homes and buy homes anywhere between the 50 to 80,000 range and still maintain that 2% rule. I know a lot of people may not be from Little Rock in here. I see some from all over. It's just a natural state. There's the healthcare strong here, just like in any other state. We have a lot of retail sales and just the regular, blue collar jobs. But Little Rock, just in the city of Little Rock alone, is 200,000 population, and the metro is about 700. So there's only about 4 counties that kind of corrals all that together, and it's just a really good market to park money that's cheap, but you can still get the yields you're looking for with a lot of less risk. And one more thing I'll add there, I didn't get to the renters market. It is about 50-50 compared to renters and owners. And the average is about 1,000. So like I said, we stay between 650 to 800.
And so I'll give you some data points from our market specifically, and then I'll give you one that's really interesting. So in April, when we were looking at our accounts receivable that came in from our 40 or 50 properties that are here in the Central Arkansas area, that we had 2 tenants of about 40 plus that indicated that they are having trouble with their cash flow. And one of them we know was eligible for unemployment, and the other one we know is going to have a stimulus check coming soon. So for our small use case, it wasn't as scary as we thought it might be in April. May will be a bigger indicator because there'll be a longer time of people being out of work. But what's interesting is I know the people that run Renters Warehouse, and they have 20,000 plus rental homes across 25 states, and they saw a only 1% drop off in collections, meaning that only 1% less of people from the normal year-to-year numbers had trouble making payments over a very large sample size. So, and I'm reading a lot of articles that would suggest that that's true across the country. So for April, it wasn't as bad. It remains to be seen how much of an impact it is in May. But by the time May shows up, a lot of people will have gotten their stimulus checks. And then a lot of people who are eligible for unemployment will have been able to work their way through the bureaucracy that it takes to apply for unemployment and get this unemployment money that is retroactive. We're even hearing cases locally of people who are being laid off, like a plumber. They're working for a company and they're being laid off, and they're going and applying for unemployment. And then they're also doing jobs on the side because they can. Now, I'll let you decide if that's something that that's a good idea or not for them, but it's not our responsibility to go and check on all of our contractors on whether or not they're filing for unemployment or not. If there are tenants, we want to make sure that they have access to funds. And what we're seeing is that there's a strong indication that it's not going to be as bad as some of us feared. So the big question here is how do you find these great discounts? It's easy to say, but what is it that we're going about doing? I'll turn that over to Austin to talk about it more.
Yeah. So one of the things that we're finding when it comes to discounted properties, Josh said it really well on the digital side, is that the search engine, the search traffic for people who want to sell their houses has gone through the roof. And just in Josh and my business alone, we've seen at like 2 leads a day about every single day coming in since COVID-19 for our business. So some of the ways you can find discounts and there's a lot, but I was just thinking through 3 here was distressed properties. Most of these you're going to see that are properties that have gotten run down because the person just hasn't really been able to take care of the house. Maybe it's vacant. We just did a deal recently where the house was vacant for 5 years, and someone just left their house like that. So distressed properties, knowing the right people. For some people here who are new, one of the best ways to find discounted properties is to use people that are in your market that know it well and to connect with them. And then, like Josh said before, would be online marketing. We're finding that if you're not online, you're not going to find deals because everybody has a phone now. Everybody's Googling these things right away. And in marketing, we call them these micro moments. You want to catch people at a micro moment where, just on Facebook, like when they're scrolling, they think of something really quickly, that thought goes away. You want to be there when they think that thought. And then the other thing is once you let's say you find a property and you get connected with somebody, you have to have an understanding of, is this a good buy? Just because it's distressed or just because it seems like a good deal, you want to know what not to buy, how to renovate, and what to buy. So having an understanding there, and that's where we can jump in some questions later about how do you know if this is a good deal or not? And then also having an understanding about how to create value to that property is going to help you when you talk to these people about their property. So having that understanding will really help. And then I think the next slide there, I don't know if I can change it. Yeah. So then we're also seeing in our business with talking to people who have these properties that COVID-19 is really affecting the sellers. So this past week alone, I've done actually 4 different Zoom meetings of houses where people are walking through to take a look at it. And people are getting almost, I don't want to say they're desperate, but they are getting very anxious about the future. And they're looking for new opportunities. So a lot of people are wanting to get out of their house. So this is a very good time to be reaching out to people who are looking to sell. And then also, how do you approach a person in COVID-19? We have specifically thought about looking at their best interest and helping them in their pain points. So it might not just be the COVID-19 that's affecting them. They may want to move. They could have back taxes they're working on. So, you always want to just look out for their best interest, like any successful business would do to help their client.
Yeah, so let's talk about why we feel like we have a competitive advantage in the marketplace. And for one, I've been studying and preparing myself for this inevitability. I've been able to run the business when it was already difficult. And now that it's getting a little bit easier, or I anticipate it's going to be getting a little bit easier, I'm in a place where I can solve anybody's problem, or most anybody's problem that has a little bit of cash flow or equity in their house, because I know how to do buying subject to the existing mortgage. I know how to do owner financing. I know how to structure these deals to solve problems. And we look for we spend less time looking at the property and a lot more time talking to the seller and finding out what their problem is. We're not always the answer, but we can always refer them to somebody who can give them an answer. And when we are the answer, we're happy to step in and provide a quick and easy transaction. And one of the reasons we're able to be quick about that is because we use private money. We're not having to wait on a bank to go through a 30, 45 day process. And in these times, banks are tapping the brakes a little bit, trying just to kind of see how things are. Some are lending, some are not. I just did a closing yesterday where I was doing a refinance. It worked just fine. I did a closing today where I had to do what they call a drive-by closing. I had to sign one piece of paper wet, and everything else was all digital. And I think that is going to be the way things are going. Well, I've been trying to run my business digitally like that for months now. So that isn't going to be that big of a stretch to be able to buy properties and in a virtual format, whether you're wholesaling or not. It is being able to be quick and nimble because you have access to capital and access to deals is going to make you a better investor and be able to do more volume more quickly. And so we're going to go through a couple of case studies and kind of show you what we do in our businesses. And we're all starting to kind of see it up here because we like to see real deals. And so these are all real deals that each of us have done. So this is a deal that I did in Maumelle, and the property was in not terrible shape. It was pretty light cosmetic, but it was pretty dirty. And so on the left there, you see that the floor was kind of dirty. And so on the right, we changed the floor. We cleaned up the tub and the toilet, left those original, and then we reglazed the countertop and put in new fixtures and painted the cabinets with the same with new pulls. Really kind of light cosmetic stuff, but something that we can kind of see through that crufty stuff. But the reason we're able to do this one is because this lady was about to face foreclosure. She'd just gone through divorce. She had 3 kids at home. She needed out quickly. And we were able to use private money to take this property down quickly and solve the problem for everybody involved. And so before and after pictures, the top was kind of, just kind of beat up. They had kids and it had been lived in. And on the right, we did a very simple rehab. This was what we call agreeable gray, white trim, and just basic fixtures, painted cabinets, and nice laminate flooring that was already in place that we just cleaned up. We had to replace the flooring in this case. And so that's the kinds of deals that you will find in this next market cycle at a larger scale. Same thing here, really basic, new floors, new mirror, new fixtures, light glaze on the cabinet tops, and new pulls and new paint. It's just we do the same thing over and over again because this is the look people are going for, and it isn't that expensive if you have the right crews.
So in the second case study, this is the deal Cody and I did was we bought this duplex through a lender's IRA, and the purchase price from the seller was a 52, but we raised 59,000. We leveraged someone's IRA, and we were able to pull some capital out, about $7,000 for us to do renovation and to pay ourselves for our marketing. And this duplex we've actually increased the rents. One side at 25, we're going to complete the renovation as soon as they move out, but the other side we have completely renovated, and we're asking $150 more per month. And so this was a deal that we used through someone else's IRA, and we were able to pull $7,000 for renovation costs as well. And then here's some before pictures. So ARV on this property is about 80,000. When we got it, rents were 1,000. Rents as of today are $1,250. And this is the before, and then if you don't mind, yeah. So here's the renovated and just recently completed unit.
That's a nice transformation as well. Make sure and go back so you guys can see the previous. We all like to see the before and after. Make sure and notice the sword and on the wall. And you got to make a mental picture there, and that's the after. Good. That's a good one. All right.
Oh, well, I guess.
That was good.
You already covered that? Case 3?
Right. And so this is one that we did at impact investing, and it's a term where we come up with where we kind of impact the neighborhood and the community and allow people who aren't applicable for a bank loan come and we position ourselves as the bank. So on this one, we bought it for $30,000. And like, man, how do you buy a home for $30,000? Well, this is our market, and that home right there rents for $600-700. But what we did on this is we raised an additional $35 to carry a little future expenses while we had to remarket it to a new buyer. And so all we did was find a new buyer who qualifies for one who makes the income but doesn't with a bank. So we allow them to prove to us for 6 months that they can do the whole rent to own thing, and then we converted it to a note at $60,000, 10%. So basically doubling the sales price and then carrying it at 10% interest rate.
So make sure and process what was just said there, because we are starting to do more and more of this. There is a huge decline in available affordable housing, and there are a lot of people who want to own a house and earn an income, self-employed, or just don't have good credit right now, but have cash and are willing to pay, and you can charge them a premium of over what the market is 3 to 5%. You can charge them 8, 9, 10% for them to buy a property that they can live in and call their own, and you basically sell it to them on owner financing. This is a huge opportunity, and what's so amazing about this is we do this inside of other people's IRAs. So idle IRAs that are looking for a yield can do this by, and because the tax transaction is tax free because it's inside of an IRA. That's the big distinction here.
And yeah, for this one, going back to what Paul and Chris were saying in terms of the how far we go with the rehabs, we buy property with light cosmetic fix-ups, floors, paint, fixtures, and that's it. So we did this one. We bought at 72, and we went the traditional route this time. This is before we knew how to get into private money, but we needed $15,000 to close. We borrowed that money from somebody else, and we're now paying them back about $256 a month. So they're happy and we're happy, and these numbers allow us to get into the deal and still cash flow, even with paying two notes, the bank and the private lender. So that's just the nuances of the deals that we get and how strong we do. We do get them under market rent. So this one started at $500 each side, and just with a little bit of floor, paint, whatever, not too much, about $7,000 worth of work total, all in all. We were able to raise rents $300 per month total on the each side.
And Nino has a question. What's the go-to choice for flooring? Luxury vinyl tile. Next question. I love that stuff. It is bulletproof, and it's getting cheaper and cheaper to buy the original material that way as well. And it's a pretty quick install.
Yeah. So this one, I wanted to add this one in here for anybody who might be newer to investing. So I was glad to see that we had a comment there earlier. I actually house hacked this triplex where you live in one unit and you rent out the other units. So I was able to purchase this house with an FHA loan, meaning you only have to put 3.5% down on it. So you don't have to have a lot of money to even get started in this property. So then my monthly cost on that, tax, including insurance, everything, it was $2,200 a month that I pay for that triplex. Well, I was able to get it rented for my other two units for $1,150 and $1,200 a month, the other two. So my wife and I, we moved in the third, and we were actually making $150 to live in that property. So we were able to get rid of our monthly payment and actually take some money in to live in a decent house. So if you're new to this, that's a great way to get started, is house hack. You can get an FHA loan and put very little money down and acquire a property that's going to cash flow right away.
And if any of you haven't read it yet, there is a book called Set for Life from Bigger Pockets that talks about this, and is probably the single greatest decision you can make for your financial future is if you can afford to, or you're in a life situation and you're in a situation where you can find the right deal. I'm 42 years old and I got two kids. I'm not going to do this. But if you're younger or you have a little more adventurous family, you can truly set yourself for life by controlling your housing costs, because it's our biggest expense.
And I actually wanted to chime in one more thing too. It is possible to do that and then do it again. So, my wife and I, we bought the triplex, and then we were actually able to buy a duplex right after. And now we're living in the duplex, renting out the triplex, and we're still making money to live. And we have a nice place. We have a bigger place now. So you can just kind of compound that, and it pays off in the long run.
Yeah, you only got to live in the house for a year, and then you can move on to the next house. The only thing that's required with that mortgage is that you intend to live there for 1 year.
Thanks, Austin. I also did a house hack, my first property, and I kind of graduated out of that now. But I would say it's an amazing financial decision that you can make for your family. I don't think there's really anything else that can basically beat it out there. Case study number 6. I love this strategy. If you're like a wholesaler or you're someone who has a property out there, it's also referred to as wholetailing. The best thing I love about this deal that we did was I actually never even went to this house. So you see this really ugly picture here. That's the MLS listing. We purchased it for $32,000 in cash off an online listing. We thought it was about worth $120,000. We cleaned it out. We literally just went through. We had somebody going through and clean it all out, and then we immediately listed it on the MLS for $79,000. So after the closing costs, all that kind of stuff, we came out with around $36K, and it really taught me about like the power of the off market. So if you live in a very hot market, so let's say you live in a big metropolitan area, fast growth and home pricing, if you have an off market property that's available, really consider wholetailing it. Because I think sometimes people think, oh, I'm going to wholesale this and I'll make $10,000. That's a lot of money. Well, if you get creative with other people's money, if you get creative with ways that you can finance it, you can come out with a lot more on the backside than if you just wholesaled it. And it's ironic because this property just got relisted by the person that flipped it for 135. So there's multiple ways to make money into this. Obviously, we made money on our end, getting the seller and then buying it and then selling it to an investor, and then someone flipped it and made money. So it's a real estate game, just diversity of ways to make money. You can be in the deal in multiple stages.
And this was a commercial property, right?
This is actually residential.
Okay.
I didn't do the commercial owner finance deal on this one, but
Gotcha.
We'll cover that later.
Sure. So I guess what I was trying to get that or ask that question was we covered 6 different deals that are all just a little bit different. So our point here is that somebody is making money in real estate in any market cycle. So you just have to adjust to what is working in your market and what is working in the current economic cycle. And we are in the midst of a change in economic cycle. So if you were flipping in the luxury space, probably not a good idea to keep doing that. You're going to have to pivot. What are you going to do? So what we like to do as a part of our business strategy is, as we're finding these deals, how are we able to be more effective and more quick? The way we're able to do that is by using private money. So what we do is we are basically eliminating the bank from the conversation. We may bring the bank in later to refinance, but on the acquisition side, we want to be able to get that deep discount quick, close quickly, and get the property making money. And so we prefer to pay a private lender instead of a bank. So right now, if you're trying to invest your money into something that is safe and or feels like it's safe and is certain, your interest rates are going to be less than 1%. A CD or some sort of savings account, you're going to get a very, very low interest rate because it's tied to that Fed funds rate and the prime rate. Well, right now, you'll be lucky to get 1%. Well, what we do is we offer some multiple of that. So what the banks are doing is they're taking your deposits and they're paying you less than 1%, and they're turning around and lending it to investors like us at 5 or 6%. So we just rather pay a private lender 6, 7, 8% so that we can eliminate the headache of the bank, at least in the short term, so that we can tie up these properties, get them taken care of, get them making money. And then if it makes sense for us, we'll refi it out or sell it on the open market. So the way it works is we locate a property that we want to buy. We borrow from a private lender to take title to the property, and then we have a formal closing, and then the lender gets a mortgage that secures their interest in the property, and that ability to have cash from a private lender, a trusted private lender who likes us and we like them, and we're friends, and we have established a relationship together. We can do deals quickly, and there's some of the people on the call right now that have been private lenders for me, and I've been private lenders for some of the people on this call. So by doing so, we are able to create a little local economy amongst ourselves instead of going out there and someone saying that you're getting 3% for a 15-month CD, which is right now is a very generous number for a CD. I'll be surprised if that will stick around very long with the interest rates being changed the way it is. But even that is a relatively low return. So let's talk about how this process works. We find a local property that makes sense for our investment criteria, and then we raise the money with a private lender, and then we have the documents the attorney drafts up that secures the interest in the property. The private lender gets a first lien position on the property, and then we purchase the house. The funds are wired to a title company. Then we take the title to the property. Then we start rehabbing the property and we get it fixed up. We rent the property, and then as the rent payments come in, a portion of those rent payments are paid back as interest to the private lender, the same way you would with the bank, but we do it much faster. And there's nothing different about the bank except for that the person who's getting the interest is the private lender instead of the bank. Mm-hmm. And so how do you find private lenders? It's Pablo, you have personal relationships and you get on a microphone like what we're doing, you talk to people. It's all based on relationships. You're looking for someone who has a problem. If you have a idle cash, then would you not be thrilled to be able to find somebody who you trust to buy properties and that has a track record of buying properties, and they start paying you 6 or 8% interest? which is a multiple over what you can get even in the most generous cases at the local CD.
Hey, Paul, real quick, I want to jump in on Pablo's to find private lenders. I'm not sure how new or old experience he has, but when we first started 3 years ago, we were on a level playing field. We had nobody in our network that had money, so we had to go out and find it. Well, 2 houses that we had under contract were like, well, we can either try to go find. We needed $15,000 down at the time to buy 2 homes. We can either go find the money, or we can go back to doing what we're doing. Well, we chose to go out there, go to meetups, and go to the RIA. Each city has its own kind of national chapter, and that's where we found our private lenders. And we have known these people for a few months now, just going back and forth to different meetups. But it just so happened that we had the right deal in place, so the money followed. So if you can get good get good at finding the deals, the money will follow if you're out there networking.
That's exactly what I was going to say. A lot of people have trouble understanding that concept, so it's worth repeating. When you find a good deal, money will follow if you are willing to go and ask for it. So think about what it's like to go and raise money from a private bank or from a local bank to fund your deal. If you show up with, hey banker, I have this idea that I want to go find some properties. Will you go ahead and send this it through committee and get money secured for me so that I have access to $50,000 to go make a payment? That is not how it works. You bring them an actual deal with a contract and say, hey, I have this good deal. I want to get financing for it. Can you raise the money, or will you lend me the money? That's a real conversation. Everything before that is just checking your credit. Well, we do the same thing. Is we go and find the deals, and then we tell our deals, or we share our deals with people that we know that's in our network, and we say, would you like to get in on this? We'd rather pay you interest than pay the bank interest. And that's typically how the conversation goes. And when we make our payments, we want to make it work for a particular lender. So we have the choice of making monthly interest only payments, or we can have the interest accrue and pay you on the back end when we get through with the refinance or selling the property. The advantage to waiting for the money to get paid on the back end is if you have an IRA and you have to kind of keep track of what's happening with the money, sometimes it's just easier to get the money on the back end. Or if you're doing a flip, a lot of times the hard money lender is okay letting the interest accrue, and you just pay him on the back end. It's kind of a personal preference for the lender.
Yeah. But the numbers have to work on that, though, and I think you're going to get into that later. You have to be able to refinance it out and cover your principal.
Yeah, real quick, we jump on Pablo. Other things right now, if you think about it, the positioning right now is almost the best time to find private lenders. Everybody's scared of the stock market. People are pulling out like crazy. So anytime we see a massive decline in the stock market, people sell off. They get real conservative. So when you're out there offering competitive rates, better than what people, they're losing money. So if you're offering 8%, you can lock that in for a certain amount of time. It becomes really, really attractive to these people because you cannot replace security. People want and they crave security, especially if, they own their house, they have a good financial footing. They don't want to lose those things by making risky investments. So they're looking for that guaranteed payment every month in the mail. And I found that that's really big to think about who would lend to you. What's the demographic? What do they look like? What do they talk? How do they talk? How do they think? And then go after those people when you're networking.
That's exactly right. And this is a example. One of the questions here is how much do we lend? It's do we typically ask for when we raise private money? And it's usually somewhere between $50,000 and $100,000 for our market. Now, depending on your market, that might change. If your median price is higher than that, then your average ask for price might be higher. Sometimes we go as low as $15,000, depending on what the deal is. I know it's hard to believe, but at least in our market, you can find properties that you buy for 15, put 15 or 20 into it, and that are worth 60, and you're into it for a total of $30,000 to $40,000. That my very first deal I ever did was like that. And so let's just run the numbers in just on the most basic case example loan of $100,000, and we pay 8% annualized. So that works out to be $66 per month. So if we were to have a 12-month loan, then you would get $8,000 back into your as interest back to your account. And compare that to a bank CD at say 2%. I just chose a number to make the math easy. It could be 1, it could be 3, depending on what's happening in the market. That's a potential of $6,000 difference per year. Now think about the rule of 72, where how long it takes to double your money. If you are getting a 2% interest, it takes you 36 years to double your interest. If you're getting 8% interest, your money doubles every 9 years. And you only got to double your money starting with $100,000. You only got to double your money 4 or 5 times to become a millionaire. So that's what I do in my solo 401k. But the problem is I can't lend to myself. So I'm trying to figure out where I can do this kind of deals in my solo 401k. And then outside of my solo 401k, when I'm working in the market myself, I'm looking to raise private money in similar conditions. So this is just kind of a graph that shows the difference. Thanks, Darren. That the difference over time, if you were to continue to plot this out over the next 36 years, what would be the difference in the total wealth that you generated? It would be profound. If you were to start with $100,000 and grow that at 6 to 8% interest, you're going to double your every 9 to 12 years, you're going to double your money. Whereas at a 1 or 2%, you're going to double it every 36 to 72 years. And so kind of the mechanics of how this works is that you have a few basic documents. A promissory note, which is just a promise to pay. These are the terms of what I say I'm going to pay you back. $100,000 at 8%, $833 a month per month in rent are in interest only payments, and it's going to be due in 6 to 12 months. The mortgage is the document that secures that property to promise to pay. If I fail to pay, then that mortgage is what allows you to take possession of the property back over. If for some reason the person that you've lent the money to does not perform. Furthermore, you want to prove that there's hazard insurance policy in case there's a fire or a storm or something, that your investment is protected. And then, of course, title insurance to make sure that there's, which is very standard stuff. Anytime you buy a property, you're typically getting title insurance. As a lender, you want to make sure there's that you get a owner's or a lender's title policy. And those are the 4 documents that are included when we're setting up a transaction with a private lender. The banks do this every time, but you don't ever think about it. You just get this big stack of documents from a bank. Ours is like, 2 or 3 pages because it's simple and we're not a bank. So what is a lender's first concern? Rule number 1 from Warren Buffett is don't lose money. You want to protect your principal. What can you do to protect your principal? Well, you buy an asset that's worth $100,000 for no more than $75,000, giving you room, giving you equity in the property. So if something doesn't go to plan, then you have room to sell it and get your money back. And so it's just kind of a really simple graphic to kind of picture what we're doing when we're doing these transactions. The property is worth $100,000 ARV, and the maximum loan value would be 75% loan to value. So we might borrow up to $75,000. That's including the acquisition and rehab costs. So we would not exceed more than that. And so you want to leave room in the deal to make sure that you are protected. And so what we're talking about here is using the certain economic nature of what we're going through right now as an opportunity to take control of your future. So if you have lazy money out there, or somebody has lazy money out there, this is an opportunity for you to go and find deals. A lot of people are sitting on the sidelines. So there's a lot of options here. If you have a 401k from an old job, you can roll that over into an IRA and do self-direction. If you have a CD that's earning less than 1%, you now know how you can go out and look for opportunities to get a higher return. If you have idle cash and you're not sure what to do, if you're in a position where you think you can buy a property where it can earn a return, or you want to work with somebody who wants to buy a property and you can partner together, this is where the opportunities are, is finding these deals at a discount. It's all based on that. So there are a couple of options when you have access to qualified money. We talk about the inflation, we talk about the tax, this $2 trillion stimulus, and we talk about this. We're at historically low tax rates right now. Who's going to pay for this $2 trillion creation of money, this printing of money? Sooner or later, us, the taxpayers, are going to pay for it. Well, I want to live as close to a tax-free life as possible. So I'm starting to do more and more of my deals inside of my IRAs and 401ks because they are tax-deferred or tax-free environments.
Mhm.
So it's very simple if you work with somebody that you can partner with where they're finding the deal and you're putting your IRA to work tax-free. That's the opportunity that we're suggesting is available to you in the market right now. And so the way that works, if you don't already have an IRA or a solo 401k, you create one based on funds that you have now. You can make contributions now, or you can take existing accounts that you have from your previous job and roll it over into an IRA that allows self-direction, which means you can invest in real estate. So I use Equity Trust. There's Quest Trust Company I also have accounts with. There's Advanta. There's 40 plus self-directed custodians in the US right now. And you roll those funds over into an IRA, and then you find somebody who has access to a deal that you want to be a part of, and then you lend or partner with them on a deal. You fill out the paperwork. You tell them to send money to the title agent for that deal, where you agree to make 6, 8, 10%, whatever you negotiate, and then the funds are returned to you as interest, or when the deal is done, they're wired back to your original account and you have your principal back as well. And then you decide, do I do this again? And I do this in my solo 401k and my IRA almost on a weekly basis because I want to live a tax-free life where I want to pay my taxes now when interest rates are low. And on paper, my income is low because I have a lot of assets that are depreciable.
Mm-hmm.
And so the next step for you guys listening to here is, before we get into live Q&A and ask specific questions from you, is to kind of figure out where you stand and what you want to do. So you can do nothing, and that would be okay. We're not telling you that you should do something. We're telling you what we're doing and allowing you the opportunity to get involved if you want to, or you can go and do this for yourself. Real estate is a viable asset class that will become easier and easier over the next 3 to 6 months, in our opinions, to do this kind of a business. And if you want to get involved with us, then you can set up a strategy session where I'll talk to you about your specific situation. I can help you figure out how to do it yourself. I can help you figure out how you can do it with us, or there's situations where I can do it for you, where your IRA is buying assets, and then we're finding the tenant or the resident tenant owner to step into a deal and sell it owner or buy owner financing, where you're getting an 8, 9, 10% return on your money. And so what I'll do is we'll open up the question and answer, and I'll let each of you jump on a call with me if you want to have a strategy session. And so we'll just, there's a little opportunity here that you'll see under offers. This is no fee. There's no agenda other here than I want to get to know you and figure out what your opportunity is in the marketplace. What's unique to you? Could that be us working together? Maybe. Could that be you figuring out how to do it for yourself? Maybe. Let's get on the phone and find out. So let's open it up to specific questions. I see that there's still several dozen people, 30 plus people on the call here. What are you guys seeing? Go ahead.
I was gonna say, I've got a question, because I know somebody asked, what is the typical amount? Well, can't you do 2 or 3 people at once? So say if you have 100,000, everybody throws in, you get 2 people at 50,000. How would you work something like that?
Yeah, you could. So if you need to kind of cobble money together, you can set it up where there's a mortgage with multiple borrowers on it, or you can stack them. So if, say, someone borrows $80,000 and the other person borrows or lends $20,000, then you can have a first position for the 80 and a second position mortgage and note for the smaller investment. Typically, that smaller second gets a little bit higher return because they're in second position. Good question.
All right, let's see.
There's a question.
Darren bought his first property.
Yeah, a question here from Shelton was asking about saving money or waiting for things to calm down. And I think that's an important question because, just entered this kind of cycle of COVID-19. People made that first kind of mortgage payment here after, things, maybe it got laid off or whatever. The foreclosure market might take some time to catch up. I know some states, like, you can't evict right now. They might not be able to, foreclose on properties. So kind of back to your point earlier, do you see there being an opportunity here, like 3 to 6 months down the road, or if you're just sitting on cash now, there's better deals?
I'm
I think
sorry.
it's
Go ahead.
fundamentals. It's more about sticking to the fundamentals. No matter what market cycle you're in, if you're buying it right on the front end, which is something that we aim to do because we are wholesaling at the same time, so it's got to fit for us or our end buyer. So either way, if we're buying the property right, then it makes sense to jump in. You just have to mitigate your risk from there on and see number wise, as it is a numbers game. That's all it is, to see if you can. If there's more back-end ways to get out of it if you need to.
Mm-hmm. Got a question here from
and I
John.
will say,
go ahead.
I will say too, just to carry on with that, we do make sure there are multiple exit strategies for every deal that we do. We want to make sure that it works in multiple ways.
Mm-hmm.
So, that's a way we mitigate risk.
Yeah, we've got a question here from John that says, can you do these kind of deals with land? And yes, you can. Raw land is a viable way to do this. Typically, when you're buying raw land, you're buying it at pennies on the dollars for the value. So let's say it's worth 20 grand, you're buying it for $2,000, and then you're turning around and selling it for maybe $5,000 or $10,000. And a lot of times what you do is and I've done this before, but not at scale. But what you do is you typically get a down payment of $2,000 to cover your initial money. And then you take the remaining $5,000 or $10,000 that's owed as a note. So you're flipping land and turning it into notes in the back end.
Really good question here from Derek. He says, I'm 23, I have student loans to pay off, and I also live in a very expensive market. I'm assuming he says the Bay Area, so San Francisco. Is it best to look around my backyard or go out of state? And that's a really good question. If you live in a higher price market, I know Austin and I live up in Lancaster, Pennsylvania, a very fast growing market there. We found that right now is actually a good time if you're ever going to go out of state to test it. And here's why. Everybody's home right now due to COVID. And you can actually get virtual appointments, as Austin was saying earlier. People are open to virtual appointments now. It's really changing the game. So before, where it's like, okay, I don't know what this house looks like. I got to go out there. I got to see it. And most people are like, I'm not going to walk you around my house with a phone. I just met you. Now people are willing to do that because they recognize like you're not going to be able to come to their house. So if you're ever looking for a great time, Derek, I would say now is the great time to test it. Rafael Vargas, he's a huge wholesaler. You probably know him if you follow him on Instagram. They're in like 5-6 markets. They almost do everything on the phone when they're looking for property. So there is companies innovating. There's people out there that are doing a lot of this stuff digitally now where you don't actually have to be in your market, where you can go out and get probably cheaper properties and make some money on them. I think you're looking to buy rental properties. So yeah, look for the cheaper markets potentially and start now because it's a great opportunity to prove and test your methods.
Yeah, I agree. And I always tell people, if you can start in your backyard, do it because you have a competitive advantage there because you understand it in your local and you just understand the dynamics of it. However, if you live in the Bay Area or Boston or some really high cost of living area, it just becomes impractical for many cases. So a lot of the people that I work with, they're in California, they're in the West Coast, they're in the East Coast, or they're in Canada, and they can't find cash flowing deals in their markets. And so they come to places like Little Rock or equivalent markets looking for access to cash flowing deals. So I still buy properties here in Little Rock that I don't personally see. I have somebody I trust go and see. Even before COVID, I have somebody I trust go and see it. So you do all the same due diligence, but me going and looking at a given property myself doesn't add a lot of advantages to it so long as I trust somebody who can go look at it and is probably more experienced than I am.
Yeah. And to Derek's point too, I mean, a huge opportunity I see in the marketplace is college rental towns. Like college just got canceled for the rest of the year. People don't know if they're actually going to go back to college, like in physical person. And a lot of the towns that these colleges are in, the rental market is driven by the students. So a lot of these landlords are probably going to be trying to sell. If they're scared, they might be trying to sell quick. Then they're trying to sell for cash. And you have the availability to like jump in right now and kind of make some offers and get the prices at the right price points. So if the students come back, if it's a growing area, you have other people that can come in and rent that, you can get really good cash flow and good deals right now. That wasn't a market I was really thinking about the other day, because I'm in one of those markets, and I said, hey, what happens if all the students go away? Am I covered on my backside? So just think about markets like that, where there's a lot of people right now who are maybe transitioning into renting or out of renting. It's a good opportunity.
Landlords, a bunch of tired landlords right now that might sell an owner financing to you. Tim actually has a good question here about who would you recommend for figuring out how to market digitally? We have a couple on the line here. If you'd like, click on the offers form and say in the comments there that you're interested in getting to know a digital marketer. That's what me, Cody, and Chris hire Austin and Josh to do this for us. And they're the experts, and they can talk to you at great, much more length than we can here on this. So it's a good start. And Lee has a question: can an IRA be used as self-directed for investing if it's in stocks? So if you are going to create a new self-directed account, and the money that you're going to be investing in self-directed the accounts is currently invested in stocks, you would have to liquidate your stocks to be able to then roll it over into a self-directed account. Depending on what you're invested in, you may not be in a place where you want to do that right now. This is taking a big dip. Take your time, and whether or not you want to take the hit on your investments now, or do you want to, or if you still believe in the stock market, you can go ahead and kind of wait it out to see if it ever returns back to what it was a few months ago. It's kind of a personal decision that you have to decide. When you do switch over to self-directed IRA and you have stocks in place, you will have to take an investable decision where you are liquidating your current stocks into a cash position and then roll that over into a new self-directed custodian. Do you think the deals will be like 2008, 7, or 8? Well, we don't know how I've heard opinions both directions, Darren. It's hard to know how long and deep this particular recession is going to be, and if it will actually return into an actual recession. Right now, it's an externality that's created this, not market fundamentals. So we don't really know.
I want to just chime in on what Tim is asking too about resources for Facebook ads and SEO. And Tim, I would actually look into Google ads more than anything. Josh and I are finding that for our business, Google ads are the number one provider of leads for us, that not necessarily by quantity, but by quality. And Google actually has a great course that they provide themselves on how to start ads. We wholesale, and we have a website in Lancaster, and we did Google ads on it. And literally within 24 hours, we got a lead and a deal. So Google ads is what I would focus on specifically.
Over Facebook ads.
Over Facebook ads, yeah.
Okay. Pablo has a question here. He says, do you find deals through the MLS or realtors? Yes and no. So we do both on-market and off-market marketing. I think right now working in the MLS is a good approach. There's expired listings you can look for. And then there's also looking for properties that have been on the market for 30, 60, 90, 120 days, whatever makes sense in your market. And we make offers at pretty good scale on properties that are listed that have been on the market for a while that meet our buy box. Scott made a comment privately to me. He says you can leverage stocks borrowing, basically saying a margin against it, so you can increase risk. But it does increase risk if you are borrowing against your stock position. Well, that is true. You're limited to 50% of its value, and you have to do it inside of that custodian. So you wouldn't be able to take that cash and then turn around and keep it with the same custodian. You have to roll that cash over into a self-directed IRA. But what he said is right. I'm not a big fan of doing margin calls unless you know exactly you're borrowing against margin on your stock market, unless you know exactly what you're doing. Nino, yes, I will add this to the private Facebook group for our mastermind, since you're in the mastermind. Derek says, how do you recommend I get started with rental and wholesaling? Like, where's best to start learning? Bigger Pockets is a great resource. How about this? fill out the questionnaire, the Google form that's under offers, and I'll talk to you about, what, I mean, I need to know more of the situation to figure out where your gaps are. Like, is it money? Is it knowledge? Is it time? Is it expertise? All those things can be solved, but I need to figure out which one to solve first.
And Derek, that just speaks to the power of like mentorship. So a lot of people, like, and Paul's kind of offering to give you that, free mentorship there. But a lot of people in this game, they ask the same question, like, oh, where can I go learn online, or where can I go learn for free? Leveraging people who've already been doing this, who want to help you out, is the number one best way, in my opinion, to learn very quickly and fast. Like, if they can align everything for you, they've already done it. They spent their own money. They made mistakes before, they've gone through a lot of the stuff. So if you can get around those people and learn from those people, that will help you get deals done faster and help you get to places you want to be faster.
That's kind of what Chris and I did 3 years ago when we first started. Paul Thompson was a speaker at our national RIA that we attend every month. And, me and Chris just kept going up to Paul, asking him questions. And 3 years later, we're now partners. So like to Josh's point, it's just about getting out there, networking, and putting yourself around that environment to learn and grow. And like, everybody starts out on level playing field, but that's something where you've got to get out there and give yourself an advantage.
Mm-hmm. John asks, how do you determine the value of an investment property? There's a fundamental formula that we use called the Mayo formula, and you want to figure out what the after repaired value of a property is, and it's usually based on comps. So I have a YouTube channel that has a specific explanation of how to do that, and I have a podcast where I just recently went through a 3-step series on how to do the Mayo formula. Or anywhere on the internet, you can look up the Mayo formula, and it's out there.
Hey, Paul, real quick, I get this a lot of my network of people when I'm looking to raise money is they ask, what if you don't get a renter, or what if you can't flip it and sell it? What happens to my principal?
I'm sorry, I was reading the podcast is Ready Investor One, John. Was that question directed towards me, Cody?
Yeah, I was just asking. A lot of people come to me and ask me, when we're borrowing money from their IRA accounts, or just individual.
Yep.
What if it goes south? What do you do when it goes south, when you can't flip it or you can't rent it out?
Gotcha. Yeah. Anytime you're making an investment, you're taking risk. So if you're in the situation where you have overbought for a property, one of the choices is to just turn it into a rental and let the rental kind of hold court for it. That's one of the reasons I like the market that we're in, because between that $50,000 and $150,000 number, you can either flip it or hold it as a rental. And or I can sell it owner financing. I have several different exit strategies, but sometimes you just buy bad, and you want to do a lot of your options on the front end so that it doesn't turn into a situation. You want to give yourself enough room. That's why we use the Mayo formula with the 70% discount rate. That gives us room to make a mistake. That's why we're currently being a little bit tighter now on our numbers, because we're telling sellers it's a COVID-19 discount and the world's uncertain. We can't go for thin margins right now. We have to have I tell sellers all the time, I'm not in this to make the biggest profit. I'm in this to not lose money. And so not losing money is my primary objective first. The profit is secondary. So to your specific question, what are some of your options? If you've already bought a property and you're too far into it, well, you can borrow more money to rehab it to the level it needs to be, because sometimes you underestimate the repairs. That's an option. You can bring in partners. You can borrow from your 401k, $50,000. Actually, now it's $100,000. You can borrow from your 401k, or you can sell it at a fire sale and take a loss. It's never fun, but sometimes it's just better to instead of just pumping money into a property that doesn't make sense, sell that at a loss, make up for it, and move on. It's not but if you get in this property, you do over 100. If you get in this business, you do over 100 properties, you're going to lose money sooner or later. It's just you will be able to recover from it, because it's not like the property will go to zero. That's the advantage of real estate over stocks, is if you buy an individual stock and they go bankrupt, your investment goes to zero. Whereas the land always has some sort of intrinsic value unless there's a sinkhole.
Got it. Thank you.
All right. So we have about 10 or 11 more minutes here, and there's still quite a few people left on here. So if you have questions, we are here to answer them.
And also, feel free to fill out the form too. I did leave there for you to give us some feedback. We want to know how we're doing and what we're doing right and wrong, so we can better perform next time for you.
Very good. You bet, Nino. Good to hear from you.
One thing I didn't really talk on with the Little Rock market is the 2% rule. I know a lot of investors, especially on the coastal markets, are like doing everything they can just to get 1%. What's so good and fascinating about the Little Rock market is it's not the big players aren't in town yet. So us local guys have a little bit more of an advantage if we can scale quickly, like what we're doing to mass reach tons of sellers, is staying ahead of the bigger players that come into town. And so far, we're the only local competition with a few other people who are big here locally, but no outside hedge fund money has come into yet to Little Rock. So,
yeah, and with what's happened, that is going to slow down. The hedge funds are probably trying to figure out what they're going to do as well. Dennis had a question of, right when we first started, is will banks have money to lend to investors? I've heard both yes and no, and my information is both yes and no as well. There are still banks who are doing refinances in the conventional market. There are still banks that are lending to new home buyers, but depending on the bank and the underlying investor behind the bank, they are kind of waiting things out in some cases. Shelton asked the question, is it better to save money now or wait for things to calm down? I think it depends on your personal financial situation. If you are capital heavy right now, you have a lot of cash and it's sitting on the sidelines, you're kind of wondering what to do, this would be a time to evaluate your options of where to deploy it, because there are going to be deals more so than there has been. I mean, we're already seeing it already. Our volume has stepped up. So, but if you only have $5,000 of cash to your name, you don't want to take all that $5,000 and put it on a down payment on an investment property and then have no cash reserves. So you got to look at your financial situation and do what makes sense for you. This is not a time to become silly and try and invest and go for broke and not understand the fundamentals. Keep it simple. Understanding what you invest or investing what you understand the most, which is why I tend to suggest people start with single family, because it's the most intuitive asset that we can buy. And you can buy properties in the right markets, in certain markets, for well under $100,000. And that one investment, even if it goes bad, will be hard pressed to make or break you.
And just chiming in on that too, it's kind of funny because 2 years ago, when the market was crazy hot, I was being told that, hey, it's probably not the best time to buy my rental property because it's overvalued. And right now, I'm actually incredibly happy that I bought it because I'm getting rental income every month right now. My tenants have been able to pay me even through this, and it's been a good investment for me. So even whenever the market's really great, people will still think maybe you should wait for the market to dip. And then whenever it dips, people are like, oh, maybe we should wait for it to go up. So it's just kind of
time in the market is fool's errand.
It just goes back to buying it right on the front end. A lot of new, and this is what I see in new investors, is that same $100,000 house they're paying 90 for. Somebody with a more experience are paying 50 and 60. So it's about how do you generate those off-market leads. And for us, just going through Josh and Austin has really helped us tremendously to get that quality lead. It's not the quantity, it's the quality of the lead that's coming through.
Mm-hmm. Pablo has a question here. Do y'all property manage run rentals? Great question, Pablo. I think, and I've heard both yes and no from people. I definitely say like property management is a hard job. You definitely have to want to property manage. A lot of people don't want to deal with tenants. They don't want to deal with fixes. They don't want to deal with issues. And there's always going to be issues, regardless of the property, regardless of whatever. There's going to just be issues because you got humans involved, right? You got tenants in there. Mm-hmm. So what I always say is like, when we are starting out and even now is you price it so that you can have somebody come and do the property management. But if you're comfortable, especially if you're starting out, you don't have a lot of cash, you do this stuff yourself. It actually teaches you a lot about how to manage a property manager down the road, and you get you familiar with doing a lot of the small things that you can save a ton of money on. I joke around because, there's stuff that I'm sure we could call up a contractor or whatever, and they would give us a $500 quote that you can do for like $80. So you really start to learn, what the pricing is on repairs, how your property is in general. And then of course, like how to deal with people, which is never going to go away if you're in this game for a long time.
Yeah, and property management alone isn't a cure-all. You can't abdicate that over to a property manager. I've used several different property managers. I don't personally enjoy property management. I enjoy going out and looking for deals. So I am constantly trying to find the right answer to property management, and I don't think that's ever going to be a perfect solution. You want a property manager that's going to do good enough, because I currently have not found the answer to property management that it is. So it's just like, it is a godsend and I never have any problems. That's not the way it works. I hear people who claim that they found that property manager, but I personally have not found that result. No one cares about your property as much as you do. When it boils down to it, if you want to take care of a problem, you can do it yourself. Right. I mean, no one cares about your profit as much as you do. That's for sure.
Yep. Hey, real quick, we got 5 minutes left. John has a really good question though about deals that went sour. Mm-hmm. Paul, if you want to explain kind of what we did to get out from underneath that.
So one time, in one case, we changed our approach. And we were trying to say flip a property, and that wasn't working. So we went to do something else with it. Like we sold it owner financing, and then there were cases where owner financing wasn't working. So we changed our price, we changed our terms, we took a lower down payment than we were wanting, because for whatever reason that given market or that given property wasn't kind of getting us what we thought it would get for us. So it doesn't always go to plan. If you only have one exit strategy and that exit strategy doesn't work, you're kind of stuck. I mean, you have to really get clever on, like, for example, if you bought a property for Airbnb, which I haven't done, and you bought it based on the income of Airbnb only and not a long-term rental, what are you going to do when Airbnb doesn't work? They change the laws, or heaven forbid, there's a pandemic and travel shut down. So you're stuck in that situation if you can't afford to take just the $1,000 of rent versus the $3,000 rent that you priced it for. You bought it wrong on the front end, and it's really hard to fix a property that you bought wrong on the front end. Time usually fixes it if you can afford to hold on to it long enough.
And to further that point, that's why we do really underwrite our deals more stricter, is to allow us to exit. And so what that means is if a deal does go sour and it takes longer than normal, then we'll go to the bank and then just refinance out that current principal from the private money to secure them and make sure that they're taken care of.
Mm-hmm.
And John, Josh and I are going through one right now. We were flipping a property, and the contractor caught it on fire. So, and it was a great deal. We had all the numbers worked out, and we're still going through it. Actually, it's getting fixed and painted right now. But so that kind of stuff happens. You got to be ready for it.
Were you able to file an insurance claim on that?
Yeah.
Yeah.
Make sure you always have insurance.
That's
yeah. Always make sure you're adequately covered. Look at your insurance policies too. That's one thing I'll tell people, because a lot of, especially if you're dealing with older buildings. This is a little insider tip. If you're dealing with older buildings and that city or borough or jurisdiction has updated code, if there's a clause of natural event, or like a tree falls in the house, or there's a fire or whatever, the insurance actually doesn't pay out 100% on those damages. So it's called code upgrades. So when you get your insurance policies, and if you're an investor, make sure you work with an investor-friendly insurance policy agent. We found normally like the independent or local guys who come to your REI meetups are best. They'll know to add in that little section there. And it usually doesn't cost that much more, but it's super critical, because you can get burned on the backside if you have a building that was, 1920s, 1900, and they didn't do the code upgrades, and now it's 2020 and everything needs to be up to spec. So
rewired and
yeah, $10,000 electric bill. So things like that you don't always think about, like little things when you're just getting your insurance policy. It costs an extra $50 a year, but it's well worth it.
So overall, it seems like we understand that investing in real estate is there is risk involved, but it's how you mitigate that, and that all goes back to sticking with the fundamentals, buying the property right on the front end with enough protection on the downturn, and doubling down on what works. And that's what's working for us. So we're going to even underwrite even more so, more deeply discounted deals.
I do want to mention one thing. I do want to mention here one thing about the Little Rock market. We just received news, I guess it was yesterday. The Democratic Gazette released information that Amazon is going to be building a distribution center here. They haven't finalized the deal, and they have limited details available now. But that's a major impact on the local economy here.
Yeah, it'd be interesting to see how that shakes out. John asked, when and where is the next real estate meetup? Obviously, it will come after. John says 80 acres.
Yep.
Sometime after this COVID-19 thing happens, we meet once. Me, Cody, and Chris meet every Sunday. You can find it on meetup.com. It's one time a month is when we meet, but we haven't been doing it lately, obviously, because of the social distancing. When that frees up, whenever that is we'll start hosting that again. Instead of doing it, at the coffee shop, we're doing it virtually like this instead, and we just keep changing our topics. So the last question I have for you guys is, for those of you who are still on here, what topics do you want to hear about next? Because we plan on doing something like this about every week or so. We talked about the PPP and EIDL loans from the SBA last week. We did how to mitigate and deal with what's going on in the marketplace 2 weeks ago. This one we're talking about private lending and finding deals given the current uncertainty. What else do you want to hear about? Do you want to hear about sub 2, owner financing, deal structuring, marketing? Let us know.
Yep, and be sure to fill out that form if you guys want. You can tell us a little bit more about there too if you want to. If you can't get your comment in here before it's over with.
Yep, because we're going to call it here in a second.
Last note, connect with us on social media as well. If anybody is interested in that, I found it's really been interesting lately with the number of people accepting my social invites due to COVID. So I think people are now, more than ever willing to, if you're reaching out to certain people or influencers, just send them a message on Facebook or a friend request or, LinkedIn, and try to connect with people, because obviously we don't have that human element. So now more than ever, connect with people and start messaging.
Very good. I second that. We got some ideas here that we'll bounce around internally and let you know when we're meeting next. And I look forward to talking to you, anybody who fills out the Google form specifically. I appreciate y'all's time tonight. Take care.
See ya.
Take care.
Bye.
See you guys.